As a business owner, it's great to accumulate money and wealth inside of your corporation or your holding company, but the day is going to come where you need to start withdrawing money out of your operating company or your holding companies. And right now, the highest personal marginal tax rate in Ontario is 53.53%. So that means if you're at a certain income level, you're literally losing more than half of every dollar you take out of your corporation. So you need to be strategic in how you take money out. And typically, dividends and salary are the two main ways any business owner thinks of when it comes to taking money out of the corporation. There is a third, very tax effective way to redeem money out of your corporation, and that involves the use of a corporately owned whole life insurance policy. So, in this example, I'm going to break down how a business owner can corporately fund a whole life insurance policy, but ultimately to use the cash value inside of that policy for tax efficient personal income. Let's imagine this is your corporation and you have some real estate, you have some cash, you have a stock portfolio. So, what I'm suggesting is that you add a fourth asset to this mix. I'm a big fan of everything here. I think real estate, cash, stocks, they're all great. They all come with their pros. But what I'm going to suggest is that you add a fourth asset, and that would be a tax exempt whole life insurance policy. Now, the symbol I'm going to use for this is a Swiss Army knife because these types of insurance policies can do quite a few different things. So it's really in the power of understanding how to leverage them that really makes them a useful asset for your entire portfolio. So, a couple obvious points about these whole life insurance policies, and that's usually around the fact that yes, it's permanent life insurance. So, it's a tax free payout to your beneficiary. Whole life insurance does not increase in price or ever expire, so it lives as long as you do. And you can pay it off after a certain amount of years. It depends on the plan and some of the features you pick, but you're not necessarily stuck with a lifetime of payments for this insurance. The maybe not so obvious points around this type of insurance are surrounding the investment part of it, called the cash value. Now, this is the living benefits of this policy. So, with a whole life insurance policy, you don't just have to die for someone to benefit. There are massive living benefits to these types of life insurance policies. So, sometimes people think of life insurance like you have to die for money to get paid to your beneficiaries. I would look at it as it is called life insurance because you can essentially use it your entire life. Now, as you pay premiums for a whole life insurance policy, you're giving money to the insurance company. And in return, they take your money and they invest in, multi-billion, 30, 40, 50 billion dollar sized portfolios. And in return, they will pay dividends back into your whole life policy. And there is no tax on any of the annual growth. So your whole life policy, the cash value can be growing year after year, and you're not hit with any sort of tax bill. And it can be growing literally by hundreds of thousands, if not millions of dollars per year, depending on the size of your policy, without any tax bill given to you. The cash value itself is also guaranteed to go up. So it's part of the contract you sign with the insurance company that at a bare minimum, the cash value will increase year after year, regardless of what's happening in the world with the economy or interest rates or stock market or anything like that. There is a minimum guarantee. It's also, the cash value is guaranteed not to go down. So those 2 points sound somewhat similar, but if something goes up 5% in one year and down 10% the next year, it's not so helpful. So not only is it guaranteed to go up, it can't go down once it does go up. So it's like a set of stairs. Every single year, as it goes up or you receive a dividend, that is the new bottom line. That is the new step. They cannot take that away from you. That is your new bottom line. It is also very liquid. This is a highly liquid type of asset to own. And this is where a lot of the confusion comes around, where a lot of business owners, they're kind of confused. They don't want their money locked up in these insurance policies when the time comes for them to access to it. So I want to be clear that your money is never locked in. You don't have to wait 10 years to access it, or 5 years or 20 years or anything crazy like that. The money is there for you, essentially from day one. So it's a very liquid asset. It's also very flexible as far as contributions. So you can pay monthly, you can pay annually, you can skip some years, you can skip some months, you can put more in some years, less the other years. So you're not stuck with this one-time payment, take it or leave it for the next 50 years. It's very flexible as far as your cash flow and what the contributions need to be into these policies. And last, but certainly not least, this is probably the most important point in this whole slide, is you can use the cash value for tax efficient business or personal use. And you should use it. I hope you do use this during your lifetime. This is an asset that should be used during someone's lifetime, and the life insurance is on the back end when someone passes away. Now, the ironic thing is investing in a whole life insurance policy could actually help you get access or funds to make further investments, to buy real estate, and it's certainly going to outperform any just cash sitting there. So this asset is very complementary to the rest of your assets. It seamlessly integrates with real estate, with stocks, and it outperforms cash as a no-brainer. Now, let's say someone decided to invest in a tax-exempt whole life insurance policy, and I'll use this symbol again. Let's make this symbol a dollar figure. So let's say this person has been saving into this policy, and they have anywhere from $100,000 of more than $10 million sitting in the cash value. Now, this is not the death benefit. This is the cash value. This is the living benefit that you can use during your lifetime. And they're a business owner. Something comes up where they need money for business expansion, business investment, business emergency. They could leverage the cash value, whatever's in there, for any of these three purposes. So let's say they had $1 million in cash value and they needed $1 million for an emergency or a business investment opportunity. They could borrow against their policy that $1 million on a tax-free basis and use that million to do, which one of these three. And the interest could possibly be tax deductible as well, depending on what they're doing with the money. Now, that's more from a business perspective. A lot of these owners, like I said, are looking for ways to redeem money out of the corporation on a tax efficient basis. And you can do this as well with the cash value. Very similarly, you're going to take the cash value and you're going to use it as collateral. And you're either going to borrow against the cash value, and you can pay yourself dividends out of the corporation. You could pay yourself a salary. You could also assign the cash value as collateral to a bank or financial institution, and in return, they will provide you with a tax-free personal line of credit. So if someone had, I'll use the $1 million example, $1 million of cash value, they could use that million as collateral and receive a $1 million personal tax-free line of credit, and they can live off that. So what you've just done is created a very tax-efficient way for you to provide yourself with personal income, and at the same time, whatever that line of credit is, you don't necessarily have to pay it off. You would pay interest on it, of course. Some lenders even let you capitalize the interest, so the interest is being owed, but you're not paying for it out of pocket. It's being added to the balance outstanding. But the life insurance death benefit would pay off the loan outstanding if you died with the loan. So say you borrowed $1 million and the death benefit was for $5 million. They would just knock off $1 million from the $5 million and pay $4 million to your beneficiaries. Now, with this strategy, borrowing personally, there are guarantee fees to consider. There's underwriting. There's other factors that need to be thoroughly examined with an accountant, a lawyer, and someone like myself. But from a overall perspective, this is how it works. You have the cash value. You build it up in your corporation. And when the day comes where your business has a need, you can certainly use it. And when the day comes when you're going to retire or you need some sort of personal income, you can also do that as well. Now, moving this one step further, you have your corporation. Let's say someone bought a $10 million tax-exempt whole life insurance policy, but they borrowed $4 million. So they leveraged $2 or $3 million, interest was added, and over time it accrued to $4 million outstanding. The insurance company is going to pay $6 million tax-free to this person's corporation because they're going to deduct whatever amount is outstanding, which is $4 million. So they do 10 minus 4 equals 6. What's interesting, though, is a corporation is going to get a credit to its capital dividend account when the business owner passes away. And in this scenario, the credit is going to be based on the total death benefit, not necessarily the net amount paid to the corporation. So in this scenario, let's assume this individual lives to life expectancy. The credit to the CDA is going to be for $10 million. Now, why is this credit important? Whatever this credit is, you're able to take assets out of your corporation on a tax-free basis up to this amount. So in other words, $10 million of assets or money can come out of the corporation tax-free. So there's a $4 million balance outstanding, $6 million is paid tax-free to your corp. So the $6 million can come out through that $10 million credit, but you also have an additional $4 million that can come out. So you might have retained earnings in your corp that have nothing to do with the life insurance policy, but you're able to take that $4 million through this credit as well. And if you're at the 50% tax bracket, I mean, that's basically $2 million worth of additional taxes saved on that $4 million that can come out of your corporation. One step further is you may have other family members or future generations who are going to be shareholders of this corporation, or maybe there's a family trust involved in a holdco. you may decide to keep the 6 million in the corporation, or some of it at least, to pay them a steady income for a very long time. And you have other assets or other retained earnings that you could take out through the CDA. So as a business owner, you want to have options, and this corporately owned whole life insurance policy gives you the option to fund business emergencies or business opportunities, personal income, as well on the back end from an estate planning perspective. It can save you a significant amount of tax. So, in a nutshell, that is a tax exempt whole life insurance policy. They're commonly misunderstood, but when you really look at the impact they have, they are a no brainer as far as complementing anyone's portfolio. Thanks for watching.